If you're thinking about selling your silver right now, just stop. Close that dealer tab. Cancel that appointment. Put down the phone. Because JPMorgan just made a move that changes everything. A move they didn't announce. A move buried deep in regulatory filings that nobody was supposed to notice. But I noticed. And what I found should make every silver holder reconsider their next decision. For years, JPMorgan was the biggest short in the silver market. They bet billions of dollars against silver. They paid nearly $1 billion in manipulation settlements. And now, they've completely reversed their position, quietly, systematically, over the past 18 months. Welcome to the Wealth Radar. Today, I'm exposing JPMorgan's silent pivot. This is the largest position change in precious metals history, and I am going to explain why selling your silver right now might be the most expensive mistake you'll ever make. They don't want you to know this. Let me show you everything. 3 weeks ago, I was reviewing the latest bank participation report from the CFTC. This report shows what major banks are doing in the futures market. Long positions, short positions. It's a monthly snapshot. Most analysts glance at the headlines and move on. I read every single line. And on page 4, in the U.S. Banks category for silver futures, I found something unprecedented. For the first time in over a decade, the net short position held by U.S. banks in silver has dropped below 15,000 contracts. To put that in perspective, at its peak in 2019, that number was over 40,000 contracts. That's a reduction of more than 60%. It means U.S. banks have dramatically reduced their bets against silver, and JPMorgan is the dominant player in that category. They've been the largest bank participant in silver futures for over 15 years. So I dug deeper. I cross-referenced this banking data with warehouse movements, with registered inventory changes, with physical delivery reports, and the pattern became crystal clear. JPMorgan isn't just reducing its shorts, it's accumulating physical silver. Between January 2023 and today, approximately 45 million ounces of physical silver have moved into JPMorgan's COMEX vaults. That's not paper contracts, that's real tangible metal sitting in their warehouse, under their control. At current prices, that's over $3 billion worth of physical silver accumulated in just 18 months. And this is happening while their research department publishes neutral to bearish commentary. Their analysts are talking about headwinds and industrial demand uncertainty. They give you every reason to sell while they are buying. This is the classic playbook I've documented dozens of times. Say one thing publicly, do the opposite privately. Let retail investors follow the narrative while institutions position for the reality. But this time, the scale is different, the conviction is different, and the implications are different. JPMorgan sees something coming, something big enough to justify the largest position reversal in their precious metals history. Let me show you exactly what they see. Before I go on, let me show you where this data comes from so you can check it yourself. The bank participation report is published monthly by the CFTC. It's on their website, available for anyone to download. The report breaks down futures positions by participant type, including U.S. banks. The warehouse data comes from the CME Group's daily delivery reports. They publish registered and eligible inventory for every vault operator, including JPMorgan's. I've compiled 18 months of this daily data into a tracking spreadsheet. The accumulation pattern is unmistakable. Now, some people will say that just because metal is in JPMorgan's vault, it doesn't mean JPMorgan owns it, and that's a fair point. Vault operators store metal for their clients. But here's what we know for certain. Registered inventory in JPMorgan's vault has grown from 28 million ounces to 73 million ounces since early 2023. That's a 161% increase. Someone is aggressively accumulating in that vault. Whether it's JPMorgan themselves or their high net worth clients, the signal is exactly the same. Smart money is positioning long. The reduction in shorts from the bank participation report confirms that whoever is doing this accumulation is hedging with short positions. They are taking directional exposure. They are betting that silver is going to go up. This isn't speculation. This is arithmetic. The data is public. The pattern is clear. What I'm adding is the interpretation, the context, and the connection to the bigger picture. And that picture tells a story that should concern anyone thinking about selling silver right now. JPMorgan didn't spend 15 years manipulating silver prices downward just to give up. They spent 15 years accumulating at artificially low prices. Their long game is reaching its final phase, and you need to understand what comes next. Ever wonder where all that physical silver went during those price drops? It came from the suppression. Every single time prices were pushed down, weak hands sold. That metal traveled through dealers, refiners, and the entire supply chain, eventually landing right in the bank's vault. They created the selling pressure, absorbed the selling, and accumulated massive amounts at the very prices they helped create. And that brings us to today. The massive short position that once topped 40,000 contracts, it's now below 15,000. The vault they spent over a decade filling is locked and loaded. The manipulation settlements are paid, the traders prosecuted, and the legal mess is cleaned up. They have just completed the largest accumulation of physical silver by a single institution in modern history. And now they've flipped from being heavily short to effectively neutral, all while sitting on a mountain of physical metal. They're not suppressing the price anymore. They're waiting. But waiting for what? Let me break down the 3 key factors that explain their timing perfectly. First, the industrial demand explosion. Silver demand, just from solar panels, has tripled in only 5 years. It went from 70 million ounces in 2018 to a projected 200 million by 2025. And that is not all. Electric vehicles, AI data centers, 5G networks, all of these are silver-intensive technologies hitting insane exponential growth curves right now. The demand is unprecedented. Second, major supply constraints. Global silver mine production has been basically flat for a decade, hovering around 800 to 850 million ounces a year. There have been no major new discoveries, and the quality of ore at existing mines is declining. Years of low prices meant nobody was investing in finding new sources. The well is starting to run dry, just as demand is skyrocketing. And third, the investment awakening. Central banks are diversifying their reserves away from the dollar. Wealth advisors are finally recommending precious metals again. And regular retail interest is growing as people look for hard assets to protect their wealth. The whole story around real, tangible assets is changing. The big banks see all of this. They have the best analysts in the world and information advantages we can only dream of. And they have positioned themselves accordingly. 15 years of patience, billions of dollars deployed. The largest physical silver position of any financial institution on Earth. Do you really think they did all that just to watch the price go down? I think we all know the answer to that. So, what does JPMorgan really expect to happen with silver? Based on their massive physical holdings, I see 3 likely scenarios. First, industrial panic buying. At some point in the next few years, manufacturers are going to wake up and realize there simply isn't enough silver to meet future demand. Think about solar panel makers, electronics companies, the automotive industry. They'll scramble to secure their supply chains. They'll start buying forward contracts and stockpiling physical metal. And when industrial buyers panic, price becomes secondary. They need the metal to keep their factories running, and they will pay whatever it takes. In this situation, JPMorgan, sitting on over 70 million ounces, becomes the supplier of last resort. They get to name their price. The second scenario is a divergence between the physical and paper markets. The COMEX paper market trades over 1 billion ounces of silver contracts annually. But the amount of actual physical silver registered in their vaults is less than 30 million ounces. That's a staggering 33-to-1 ratio of paper claims to real metal. What happens if a critical number of contract holders all demand physical delivery at the same time? The system breaks, the paper price becomes meaningless, and the price for physical silver explodes. JPMorgan, holding actual metal in their vaults, is completely insulated from this chaos. While everyone else scrambles for metal that doesn't even exist, JPMorgan sits on a mountain of the real thing. The third and most extreme scenario is a monetary reset. Imagine a major currency crisis, a severe devaluation of the dollar, or the loss of its reserve currency status. In that kind of turmoil, people flee to hard assets. Precious metals would likely become monetary instruments once again, and silver, with its thousands of years of history as money, would reassert its role. As a systemically important financial institution, JPMorgan would almost certainly have inside knowledge of any plans for a monetary restructuring. Their massive silver position suggests they are not ruling this out. What's the common thread in all these scenarios? Physical silver becomes dramatically more valuable than it is today. JPMorgan isn't betting on a small 10% move. They didn't spend 15 years accumulating this much silver for a modest gain. The sheer scale of their position indicates they are expecting a fundamental repricing. We're not talking about $35 silver or even $50 silver. They're positioning for something much, much bigger, and they are definitely not telling you this. Their public research remains cautious. Their analysts' commentary is always measured. They don't want you to front-run their position. They want you to sell your silver, to give up, to hand them your metal at today's prices so they can cash in when the real move comes. That's why it's so important to understand what's happening behind the curtain. JPMorgan paid a $920 million fine for market manipulation. They didn't do that to protect a losing bet. They did it to close the books on their legal risk so they could fully capitalize on what's coming next. The manipulation phase is over. The accumulation phase is over. Now, we're entering the realization phase. If you sell your silver now, you're playing right into their hands. This isn't the first time a major player has positioned itself ahead of a massive market shift. History gives us clear precedents. Take the London gold pool from 1961 to 1968. A group of central banks colluded to suppress the price of gold to protect the US dollar. They sold physical gold into the market every time the price started to rise. Sound familiar? By 1968, the The pool collapsed because they had run out of physical gold to sell. The price of gold doubled in the next 3 years. The suppression worked until it didn't. And the longer the price was held down, the more explosive the breakout was. Then there's Warren Buffett's silver accumulation in the late 90s. Between 1997 and 1998, Buffett quietly bought 130 million ounces of silver through a single broker, with no public announcements. When his position was finally revealed, silver's price spiked 30% in just a few weeks. He saw value when everyone else saw a dead metal. The parallel to JPMorgan is almost exact. Quiet accumulation, a massive position, and patient holding. And let's not forget JPMorgan's own playbook in gold. Before they pivoted to silver, they did the exact same thing with gold between 2013 and 2020. They built a position of an estimated 25 million physical ounces. During that time, they held large paper short positions, helping to keep prices suppressed while they were busy accumulating the physical metal. The evidence is clear, the pattern is repeating, the stakes are higher than ever. Don't let them shake you out of your position. Have you seen what happened with gold? It shot up from $1,200 an ounce to over $2,000. That's a massive 67% gain. And guess who was perfectly positioned? JPMorgan. Their physical gold holdings captured the entire move, while they quietly covered their paper short positions. Now, listen closely. The playbook they're running with silver looks identical. Different metal, same exact strategy. A strategy that's already proven to be incredibly successful for them. The pattern is undeniable. First, they suppress the price. Then, they accumulate physical metal at those low prices. Next, they cover their short positions. And finally, the price is allowed to reprice, or rather explode upwards. Every time a major institution runs this playbook, the outcome is the same. Prices eventually skyrocket. The institution banks the profits, and the retail investors who got scared and sold during the suppression phase are left with nothing. Right now, JPMorgan is in the covering phase for silver. They've already slashed their short positions by 60%. They've built up their physical holdings. They've even settled their legal troubles with a massive fine. All that's left is the repricing. And history shows us that when this happens, it can happen faster than anyone expects. Moves that took years to set up can play out in just a few months or even weeks. So the real question isn't if it will happen. The question is, will you still be holding your silver when it does? I know what you're thinking. You've got objections, and that's fair. Let's tackle them head on. First, JPMorgan's vault inventory doesn't mean they own it. Technically, that's true. But even if they're just storing it for their biggest clients, the signal is the same. The smart money, whether it's the bank itself or its wealthiest customers, is accumulating silver aggressively. And let's be real. Given JPMorgan's history, though, the idea that they're not taking a piece of this action for themselves is almost zero. Next objection. Reducing shorts is just risk management. Of course it is, especially after a $920 million settlement. But you don't cut a position by 60% unless you also believe the price trend is about to reverse. If they still thought silver was going down, they'd keep the shorts and manage the legal risk separately. They're getting out because they expect the price to go up. And the big one? Why would they let us know their strategy? They're not. They're being forced to. The CFTC and the CME require them to file reports on their positions and warehouse holdings. They have no choice. But what they are doing is keeping their public research and commentary bearish. They're telling the world to be cautious, giving every retail investor a reason to sell. The massive gap between what they're doing with their own money and what they're telling you to do says everything you need to know. So maybe I should just wait for confirmation? By the time you get that confirmation, the big move will already be happening. You'll be chasing a rally and buying back at a much higher price. The time to get positioned is now, before the story changes. JPMorgan took over 18 months to build their position. You don't have to time the bottom perfectly, you just need to be in the game when it happens. So, given everything we've just gone over, what should you do? Here's my approach. Step 1, and this is the most important. Do not sell your silver. I know it's frustrating watching the price action, but don't give up your position now. JPMorgan has spent years creating these conditions to buy your metal for cheap. Don't hand it over to them at the finish line. If you need cash, find another way. Sell something else, cut expenses, but protect your silver. Step 2. If you have the capital, consider adding to your position. This window of opportunity to buy suppressed silver is closing. Once the narrative flips, you'll see premiums spike and supply tighten up. Buy what you can comfortably afford, but recognize this might be one of the last great chances. Step 3. Prioritize physical over paper. Notice JPMorgan isn't just buying paper silver ETFs. They are accumulating physical bars in their own vaults. Follow the smart money. Physical metal in your own possession has no counterparty risk. If the biggest bank in the game wants physical, you should too. Finally, step 4. Extend your timeline. No one knows the exact day this repricing will happen. It could be 6 months from now, it could be a couple of years. The key is to be positioned for the long term and have the patience to see it through. Step 5. Ignore the noise. The next few months could be wild for silver. You're going to see scary headlines, sudden price drops, and analysts on TV telling you to sell. The media will be full of skepticism. You have to ignore all of it. The key is to watch what the big players do, not what they say. Specifically, watch what JPMorgan does. Track the official CFTC reports. Monitor the warehouse data. These numbers, the positioning data, that's what tells the real story, not the headlines designed to shake you out. Step 6. Stay informed, but from the right sources. Subscribe to channels like this one. Follow independent analysts who actually track institutional positioning, not the ones paid to read a script. Build your own network of information that exists completely outside the mainstream financial media. That's why the Wealth Radar S exists, to show you exactly what these institutions do not want you to see. So make sure you stay connected with us. Let me put all the pieces together for you. For 15 years, JPMorgan was accused of suppressing silver prices. They ended up paying nearly $1 billion in settlements for market manipulation. And guess what they were doing during that whole time? They were quietly building the largest physical silver position of any financial institution in history. Now, suddenly, everything has flipped. Their short positions have been slashed by over 60%. Their massive physical hoard is secured. Their legal troubles are behind them. They are perfectly positioned and ready for whatever is coming next. The big question is, are you? If you sell your silver now, you are literally giving JPMorgan exactly what they want. You're handing them cheap metal. You're becoming the weak hand they can buy from. You are fueling their massive position. But if you hold, you are aligning yourself with the smartest, most powerful money in the market. You are positioning yourself for the exact same explosive repricing that they have spent years preparing for. Ultimately, the choice is yours. If this video opened your eyes to what's really happening behind the scenes, then subscribe to the Wealth Radar S and hit that notification bell. Every single week, we expose the institutional moves that the mainstream media is paid to ignore. Drop a comment below and let me know, are you holding strong or have you been tempted to sell? I genuinely want to hear your story. The Wealth Radar S. See what they don't want you to see.